It's really a pleasure to be here and see all the students. It kind of reminds me, especially what you all stand for here, free markets, and that I think is very important. We never know the influence we have on students. When I was, I think I was home on leave when I was in the military, and my brother said, gee, Nick is down at SIU, let's go down and visit him. And so we drove down and I visited Nick Calamos, my nephew, and I asked him how college was going, and he was going to be a gym teacher, and he started talking about economics, and I said, who told you that? And who told you that? And you need to read this book and this book. And I had that conversation. I sent him about 2 or 3 books and didn't hear about it for until he graduated, and he had changed his major to economics and finance. And today, Nick is Chief Investment Officer along with myself at Calamos Investments. So you never know the impact that you have on people. And so it's really a pleasure for me to be here and talk to you. One of the questions that came up is really how did my days of a student really prepare me for my future? And I was probably a bit of a confused student. You know, I thought I wanted to be an architect, and you know, I had all the engineering, but I didn't have the design. And I was always worried about, you know, that really weird kid with all the design talent. I'm going to end up working for him. So I changed, and I always had an interest in the markets, so I really changed my major to economics and finance. But one thing about being a student, and I hear this a lot, we have a lot of finance students, I'm sure, in here in business and economics. What really helped me the most is not so much the study of finance. It's not even the study of math. You have to know it. You have to get that right. I'll tell you what helped me the most, studying philosophy. And we don't have enough of that going on. Learning how to think, not just how to come to some 3 decimal point answer. So of the courses that I took as an undergraduate and graduate course, the courses I remember the most was studying Socrates, Plato, Aristotle, as well as Adam Smith. The philosophy is really important, and if you haven't been doing that, I would encourage you to do that. One of the things that that really helps, I think, is especially in philosophy, is you need to really delve into some questions like, what is justice? What is right? What is wrong? It's not a mathematical equation. You have to think. And we've just gone through such a horrendous period in 2008. I don't think enough people were thinking. I think they got caught up in mathematical equations and they forgot how to think. So I would encourage you to do that. One of the things I learned early on in my studies that I think helped me as well is that what is economics? What is Econ 101? I hated it. Supply, demand, math here, what's going on here. And then when I got into philosophy, what is really economics? You know what they forgot about? It's called political economy. It's philosophy. It's not just about the math. Political economy says, what economic system should we organize ourselves in which we want to live? The basic principle of political economy, to me, is really individual liberty. It's all about individual liberty. If you don't have economic freedom, you don't have individual liberty. So that's a principle by which I weigh everything on. So that really helped me, and it continued to really make me think a lot about what I was doing. A little bit more about my background. Coming out of college, I was in ROTC, so I joined the Air Force as a fighter pilot, and spent 5 years on active duty. I had a tour in Vietnam as was mentioned. My last tour was flying B-52s up in Minot, North Dakota. In case you don't know where that is, it's 40 miles from nowhere. But I'm sitting on alert, waiting for World War III to happen, and I'm thinking, well, what if it doesn't happen? Maybe I should be studying. So I started studying finance again, really got back into it, and read a couple books. One of the books was by an MIT professor, Thorpe, on hedging and convertibles and how you hedge them. And when I got out of the Air Force in 1970, that's what I started doing. I started buying convertibles, shorting warrants, and when the options exchange came in, I started selling options against them. Very successful strategy. And by 1977, after being frustrated by trying to work within a system that kept wanting me to do other things than what I wanted to do, I said, you know, I'll just set up my own company, I'll do what I want. And so in 1977, we started a broker-dealer, and then in 1979, an investment advisory firm. So over those years, I was investing in convertibles before they were really even considered an asset class. And today, Calamos Investments is managing almost $31 billion, and we're the largest convertible bond manager in the world. We manage portfolios across borders in there. So kind of understanding that is pretty important. My other point about being a student that I think is really important is a history. Any subject you get into, if you don't know the history, you don't know the subject. If you want to learn about investment, one of the books I read was a novel about Jim Fisk during the turn of the century in the Erie Railroad, and how there was a short sale squeeze and they were printing certificates. It just got me all excited about the financial markets. So the other advice I'd give you as a student is whatever subject you're in, know the whole history of it. It really makes it come alive. A little bit about the history of Calamos Investments. As you know, I mentioned I started in 1977 and wanted to get into I felt much more professional as an investment advisor rather than as a stockbroker. So I registered as an investment advisor and wrote a couple letters, and somebody actually gave me, it was actually Delta Airlines in their pension fund gave me $5 million. And I said, oh my God, this is a lot of money. And it is a lot of money today, but it became my first institutional client managing a convertible portfolio for part of their pension fund. And for over 30 years, they've been a client. So it was my first client, and over that years. And from there, we expanded. And when we started growing the business, we had to decide how we're going to do things. And a lot of money management firms, what they do is they try and find smart people, put them in each corner and say, go for it, let's see what you can do. And that made me a little nervous. My military experience was all about camaraderie, is all about taking risks but managing risk, it was all about backing each other up. It was, you know, the quote, the band of brothers, very important. Some of my best friends today are my military buddies. I still see them a couple times a year. And so when we set up the investment firm, I set it up under a team approach. First of all, it wasn't much different than flying airplanes. You're in a very risky situation. The more you know, the better you're going to get through it. But there'll be always events that you can't control. But it's all about managing risk. If you read anything on Calamos Investments, it's about managing risks, not about managing performance. So over the years, we ended up setting up a team approach in how we manage money, which is much different than a lot of Wall Street. So we have 60 people on the team. Nick, as I told you, in college he ended up changing his major, and I didn't even realize that. My brother was on a trading desk and he said, Joe, Nick is Nick just finished college. You have any work for him to do? And we just moved from Chicago to Oak Brook, and I said, yeah, we've got all this furniture to move. Have him come in. So he came in, and I had just bought my Apple computer. And, you know, I've been doing everything with graph paper and French curves and doing this. And I said, Nick, they teach anything about computers? In fact, those days they did not. They taught him what an IBM card was, but not about programming. But he took to it, and he started computerizing our research system back then. And, you know, and Nick is, as I told you, been with the firm over 25 years now. And really that was the beginning of computerizing our research system and really creating the team approach. So in our firm, everybody uses the same process, and what we want to do is continue to improve the process on an ongoing basis. And we think that it has leveraged a lot of talent. Just to give you a bit of an overview on the company is today Calamos Asset Management is about 330 employees, 52 investment professionals. We're a public company. That's good or bad depending if the stock is going up or down. And we manage over $30 billion in assets. We're considered one of the largest convertible bond managers in the world. And we just opened up an office in London. So we're going much more global than ever before. We have clients in Europe as well as the U.S., pension clients, as well as a whole series of mutual funds. So the one team, one process approach to investing really has worked well for us. I think looking back, it did come out of my military background about teams, and we feel it's really helped us with our performance over the years. Let me talk a little bit about what happened in the market and maybe a bit about our outlook in here. First of all, the way I've looked at the current market environment, especially 2008, is that for 40 years we did not have to worry about systemic risk. And then systemic risk just came up and just fooled a lot of people, most people, 99% of the people, I would say. And it is virtually, systemic risk is virtually a whole collapse of the financial system. And in that, there's no place to hide. And our teachings in business and economics is that that's not supposed to happen. What probability theory says the whole system collapses? What normal curve are you looking at that says that? So all of a sudden, it is testing rational expectations, probability theory. It's testing all those theories all at once. And there's a lot of doubt in a lot of investment professionals if those theories are valid anymore, and with good reason. We surely are testing those theories. So again, I think we got caught up, when I look back at it, we got caught up with the idea that everything's a math problem and you don't have to think beyond the equation. We're doing a lot more work on just thinking about what to do. You need the equations, you need the quantitative work, but that doesn't always drive you to the right answer. And so it's really important, I think, that that thinking about what's going on in the markets is pretty important. One of the things that we do is we put out our outlook. Our latest outlook said we were short-term bullish, long-term scared. So I like to kind of give you our feelings about that. I used to say we're short-term scared, long-term bullish, under the idea that short-term market timing doesn't work very well and you had to have a longer-term perspective. We kind of flip-flop that now, and we're short-term bullish, long-term scared. The bullish comes from the markets right now, to us, the financial markets, are a very different area to be in. I think we need to really look at them very hard. We're seeing a lot of opportunities. And when we get in a period like this, people forget about opportunities. And in the 70s, there was a lot of opportunities. I was on I spoke at a conference in San Francisco, and Charles Schwab was in that conference, and he started his company in the 1970s. I met a client the other day. He started a medical company, a very successful one, in the 1970s. And I got to thinking, if the 70s weren't so bad, would I have started the company? Would I have taken that risk? So in periods like this is very opportunistic. There is a lot to be done. And I think the people that will not be successful are the ones sitting on their hands, waiting for everything to be all right, waiting for all the ducks to get aligned, all the stars to get aligned. This is a very opportunistic area. In the stock market, I won't go into a lot of that, but we're finding a lot of opportunities here in the market, mainly offshore, but a lot of opportunities in the market here. Stocks and companies are undervalued in our mind, and that's providing a lot of opportunity. It reminds me of the 1970s and the early 80s. What most people, you have to remind them of, is that when I got in the market in 1970, the Dow was 1,000. It took literally 12 years for the Dow to get back above 1,000. So you would think, wow, what were you to do? Well, I'm going to buy an index fund and just sit there and wait. And someday the markets will go up. That's not what I did. I looked at grinding out a return every quarter, because on the way, sideways market, the market went down, market went back up, it went down, went back up, and we were taking advantage of those opportunities. So, and the turn in the market is never advertised very well. In 1982, what was the environment we were in? And this is going to sound familiar. The worst unemployment rate since World War II, 1982. The worst GDP numbers since World War II, 1982. I think it was, I'm not sure, but I think it was Business Week came out with a front cover, the death of equities. The stock market would never go up as far in the future. August of 1982, the market pierced 1,000, one of the best bull markets in history. So bull markets do not begin when all the ducks are aligned, everything's fine, everything's going well. It's probably a top of the market, not the bottom. So keep that in mind as you look to invest. One of the things that we learn, is that systemic risk is now a reality, and we have to manage that, and that's going to be a difficult proposition for a lot of us going forward, because it can really come about almost at any time. So managing systemic risk is going to be difficult. The difference now between the 1970s and early 80s and today is that in the 1970s and the 80s, you had to depend on your U.S. investments. You couldn't go anywhere else. You were stuck. And if our markets didn't do well, you were stuck in our markets. Today, that is not the case. You can very easily invest outside the United States, and money will look for opportunities. So this is a big change from the 1970s and early 80s, and it's a very positive change. I think it's positive from the view that if we make a policy mistake, if we do the wrong things from an economic point of view, monies will flow out of the United States into economies that are making the right moves. So the flow of funds around the world is really a check on bad government policy. And we see that happening all the time. So bad government policy is not going to last very long unless we don't care about our standards of living. And so that's a real check, and I think that's a positive right now. I wanted to, make sure I leave some time for answering your questions, but let me talk a little bit about being long-term scared. And the reason we're long-term scared is that we kind of feel we're getting set up for an inflation spike. And when you see the amount of debt that's going on right now, the weak dollar, those type of factors, we can get into an inflationary environment pretty quick. The problem with it is not going to be that easy to predict. It's kind of like a systemic risk. You need to be protecting yourself before the event, not after the event. So if we do have an inflationary period like that, it may very well be going back to the 70s. And in that period, inflation really, came about so quickly that the bond market got crushed. And if we look at see what's going in the bond market today, all monies are flowing into bonds. So here we are, money's flowing into bonds with 3 or 4% coupon. People are saying no inflation, no inflation. Why do we say no inflation? CPI. Well, whose index is it the CPI? The government's. So how do we get into this mess? Low interest rates, too low for too long. Why? Because there was no inflation. Well, let's look at that. Housing prices went up 25% annualized for 3 or 4 years. Well, we don't count housing prices, the government says. We only count rent. Oh, well, oil prices tripled. Oh, we don't count oil prices. So they just count whatever they want to count, and now they have tips. They can't count anything that increases their costs. So we need to be looking, how can you tell me there's no inflation with housing going up and all this? So in reality, we had a lot of inflation in my mind. And the Fed mistakenly took the low inflation period and kept interest rates too low for too long. And when you do that, what you end up is an over-leveraged economy, over-leveraged on the consumer side, over-leveraged across the board. And we're paying that price now in the massive deleveraging that's going on. So part of investing today is to really take that and see how we can protect ourselves against that going forward. The other thing that we're doing is really looking at some longer-term investment themes. So I didn't want to leave this on a kind of a dark note. So where are the opportunities in investing today? And long-term investment themes, I think, are important because they're winds at your back. If you can find companies that are playing into longer-term investment themes, things will work out. And at least you have that higher probability that they'll work out. So some of our themes are world is starved for information and entertainment. Consumers not buying, right? How many people have iPhones? Anybody buying iPhones? Anybody buying those? So they're really, the right product comes out, people buy them. People want access to everything, anywhere, anytime. No matter where you're at, you want access to it. And that theme, we want companies that are part of that theme. The world is flat. Marketplace is global in competition. That's a theme. We're competing on a global basis now. When I go to Europe 3 or 4 times a year because we're doing quite a bit of business there. And when I first started going there, I was really quite amazed because I kept coming back home and I said, you know, the Europeans are going to become more and more like us. They're very competitive. They're cutting taxes. They're really trying to compete with us head on, which they haven't done for a long time. Now I come back and I said, you know, the Europeans are becoming much like we were, and we're becoming more like they were. And it's a whole different philosophy in there. You know, we want to take care of everyone. So the world is flat is really a theme that we think will continue. Part of that is what really makes societies great, and is that a theme? I think it is. What made America great? The middle class. The working middle class makes America great. And when you look at the growth of the middle class, that's what made America great. And if you look when we look at outside the United States, we look and see where is there growing middle classes. How come China bought more cars last year than we bought? It's because they have a growing middle class. Do you know that China's middle class is now equal to ours? In fact, it's greater than ours. And they still have another 750 million people to go. So we're maxed out, and their middle class continues to expand. And if you looked at some of the numbers, it's kind of like a hockey stick curve. When people come from the rice paddies to the city and they make $10,000, let's say, what do they buy? A dishwasher and a dryer. And who buys them? All 10 million of them, all at once. So it's like this. They get to 15,000 or 20,000, my numbers may be off here, and they all want a car. And they all buy them all at once. And that's driving consumption a lot. So we look at the middle class in China, the middle class in India, and we get pretty excited about what's going on. They're not going to have a healthcare program for everybody in China. Why not? How can they do it? They got 750 million people still in the rice paddies. What are you going to do? Give them free health insurance? Who's going to pay for it? So that's the differences that we're looking at. Another investment theme that we think is very valid is energy and environmental fears. They need green solutions. And that's got to be driven by business and economics. I think too many people feel that somehow the government can control all this and make it happen. I think they're forgetting. When I was growing up, and was during the Cold War, have people forgotten about the 7-year program in Russia, the 5-year program in Russia, the 10-year program in Russia? How come none of those succeeded? And if the government could run everything, why isn't Russia the greatest country on the earth today? I mean, I remember reading a story where they were controlling all the autos that they were building and everything, but they forgot how many windshield wipers they needed. And there was this huge black market in Russia because nobody could produce windshield wipers. So everybody, anytime you got out of your car, you took your windshield wipers with you. Why? Well, somebody here would say, hey, there's a market here, let's build one. No, not in Russia, it's government. Government will tell you when to build those windshield wipers. So I think we're forgetting often that what economics is also about is the most efficient use of resources. If we have the most efficient use of resources, that will raise everyone's standard of living. And I think what people forget about free markets is that that's what really works. When you read Adam Smith, that's what he said. You know, everybody striving for their own personal good will raise everyone. And I think what's mistaken about that is people take that to mean that they're going to take advantage of other people. So the government shouldn't be involved. The government needs to be involved as the referee to make it fair. We just saw that in the financial markets. One of the problems with Wall Street is that it's not a fair playing field. If you're a hedge fund, guess what you get to do? You get to look underneath the tent. If you're a mutual fund under the 1940 Act and you're regulated by the SEC, they're in our offices twice a year. They're looking at every trade we do. They make sure that there's no conflict of interest in there. If you're a hedge fund, you're not regulated by anybody. You can do what you want. And guess what? Some guys got caught inside trading, and pretty big. And I think it's just the tip of the iceberg. There's a lot of inside trading because they're not regulated. So free markets does not mean you do whatever you want. You can't play football without a referee. You have the offense, the defense, and free markets are dependent on referees to make it a fair playing field. So that's part of what needs to be done, in my view, going forward. What I'd like to do at this point is open it up to any questions. In our meeting before this, there was all kinds of questions that were pretty varied, and so I'd like to accommodate any questions you might have. Yes, sir.
You mentioned political economy earlier in your speech, and I wondered, when you look at what happened in the financial community, particularly banks, in the low interest rates you mentioned, do you feel like the political power of the financial institutions is delivering an outcome that's favorable to the public, or is there stuff that we need to address in the political system, fundraising, et cetera, that would improve our outcomes?
Well, definitely there are things that we can be doing differently than we did before. I think we have to understand part of what happened. And part of what happened was low interest rates in an environment that too much leverage was taken on, right? So you have a firm like Merrill Lynch, which went from typical leverage of a bank is 7-to-1, 8-to-1, and went to 40-to-1. So all of a sudden it had a high leverage. AIG is a good example. What is a credit default swap? You know what a credit default swap is? It's really a bet that this credit will not default. So it's like an insurance policy on this credit that won't default. So how does AIG go under because of credit default swaps? AIG is an insurance company, right? And they're regulated. They're regulated by the state they're in. So what do? They say, we're in credit default swaps. We can't call it credit default insurance. If we call it insurance, we'd be regulated. Let's call it a credit default swap. So that whole part of their business was unregulated, and it cratered the whole company. So we need more sense type of regulation in there. And the other thing is more transparency. Wall Street lives off the lack of transparency. They live off that bid in the ass spread. They just live off it. And they never want transparency. They always, if they're trading, if you're buying and you're selling, they want to be the middle guy. If I knew exactly what you were selling for, I knew what you were buying for, it's called electronic trading, it'd be done like that. But they step in between. So they fight transparency all the time. And it came to haunt them because all those credit default swaps were not transparent. They weren't traded. And who knew what was going on? The hedge funds. They could look underneath the tent. They could figure out what's going on. They could short them. They can do all that. When you read the story of Lehman Brothers, what happened to them was hedge funds shorting a lot of that got them in trouble. So, I think, I'm all for free markets, but I'm all for fair markets and more fairness in that. So, yes, sir.
You suggested that the U.S. is becoming more like Europe like the U.S. of old. How does that get back on the right track again?
Well, I said earlier that Europe is becoming more like we were, and the U.S. is becoming more like what Europe was. I don't know. That's a political decision we're all going to have to make. So it's a little fearful. I guess at this point we're relying on the confidence that no matter what happens, the American people will eventually do the right thing to their own well-being. I'm hoping that's true. I had the same misgivings in the 1970s. We had lines in the street for oil, for buying gas. We had a crisis on all fuel oil and all that, and our president said, "Put a sweater on." This was his solution. So, I was ready to leave the country. I said, 4 more years of this, and I'm out of here. And it's tough. I think it's going to take a little bit more education and hopefully a bit more of a more rational debate, I hope. A more rational debate. The first election I was able to vote in was JFK, Kennedy. I voted for Kennedy. I thought he was terrific, the charisma. I was excited. I was a college student, very excited. The second election I was able to vote on was Goldwater and Johnson, and I voted for Goldwater. And so I had transformed my thinking from JFK to Goldwater, and they would tell me, "John, if you vote for Goldwater, in 6 months you'll be in Vietnam." So I voted for Goldwater, and 6 months I was in Vietnam. But most people don't know that JFK and Barry Goldwater were great friends. They could have a rational discussion about conservatism, which meant economic conservatism, not the far right, and liberal policies. They were actually going to get on the same airplane and debate that in there. And that's the way it was done back then. It wasn't until Johnson that all of a sudden it became character assassination. So I think we need more of a rational debate going on. And what I see going on, if you disagree with somebody, they assassinate your character. They never talk about the principle. It's like, isn't there another idea that we could disagree, but we could have a rational debate? I'm hoping we'll get to some point where we have a rational debate. Any other questions? Yes, sir.
Yes, I have a question about the energy and environmental section that you were mentioning about. Could you maybe comment on some practical business strategies that are possibly going forward to manage resources well and maximize productivity?
Remember to repeat the question, please.
Yeah. Sure. One of the themes I talked about was the energy and environmental fears and the need for a green solution and how that impacts going forward. Part of our thinking there is this is a real issue, and we're looking for companies that are actually doing something about it. It'll be a win at their back. I don't know what all the solutions are. I'm sure technology is going to play into it a bit. I hope it's not merely a tax program. I don't know if that really solves the issue. So we're looking at companies that are looking for solutions in this area. I think if you find a company, it could be a company with a light bulb that doesn't take any heat, that lasts a long time. There's all kinds of things. I don't know if building all these wind things all over the Southern Illinois is the right solution, but who has the most nuclear energy in the world? What country? France. We're afraid of it, right? We can't build a nuclear power plant because we're afraid. Do you know how many nuclear subs are floating all over the world today? We don't know where they are. Couldn't you build a plant and you know it's right here and watch it? Do you know that a nuclear sub could park in San Francisco Bay, plug in San Francisco, and light up the whole town? Is that a solution? Oh no, it's not politically acceptable. It's politically acceptable to France. So those are the kind of solutions that we need to be talking about. And if we can find companies that are not only that are really driven by business and productivity. One of the great strengths of the United States has always been productivity gains. And so being able to do that in the energy area, I think would be very beneficial. Any other questions? Yes, sir.
Deleveraging and inflation, when has that occurred in the past, and what kind of factors kind of contribute to that happening at the same time?
Well, deleveraging, I think I would say probably in the 1930s, a lot of deleveraging was going on in there, and that's a deflationary period. What's going on? So when did deleveraging occur in the past? You know, those factors have been around for a long time. Deleveraging usually occurs as interest rates are going up. So when I said that the Fed kept interest rates too low for too long, really the check on too much leverage would have been higher interest rates. Wall Street would have been leveraged up, consumers would not have been leveraged up. There would have been, you don't take second and third mortgages out on your house to drive your consumer. You know, you go back to, gee, you know, part of my financial planning is I want to pay off my house, not borrow against it. So I think the deleveraging went so far that it really caused that problem. The issue we have now, how long does it take for this to correct itself? And what you see happening right now is that the consumer is saving more. The savings rate continues to go up because consumers are fixing their balance sheet. That's what's going on. And the ones that aren't, in the corporate world, real estate and others, there's a whole pile of money sitting here waiting to gobble up there. So it's going to go from weak hands, the ones that don't have enough equity in there, in the banks, driving that to stronger hands. So you'll see there's piles of money out there that will be buying real estate at 50 cents on the dollar, taking advantage of that, so it goes from weak hands to strong hands. And by the way, in an inflationary environment, who has a lot of dollars? China. So, well, you think they're just going to accept those weak dollars? They're going to take those dollars and buy our assets for 50 cents on the dollar, 20 cents on the dollar. So that's one of the things that could be happening in the future. Yes, sir.
Where do you see the situation with ETFs versus mutual funds playing out over the next 5 or 10 years?
Where do I see the ETFs and mutual funds playing out over the next 5 years? I think the ETF market is really the trend towards more and more indexing. You know, we don't have enough ways to slice and dice the market. We need to find a whole new way to slice and dice the market. You know, there's an old saying, it's not a stock market, it's a market of stocks. Well, ETFs and indexing, it's just a market of stocks. And a couple things to me that are wrong there is the market mechanism is supposed to be a resource allocator, an efficient allocator of capital. So the companies that do well will get the capital because their prices will go up. If the reason your price goes up is simply because you're in an index, how is that an efficient? There are now more indexes and more funds than there are stocks. So we've sliced and diced the market so way. And the ETF is really, here's what the SEC said 4 or 5 years ago. It said, we don't like people that buy a fund and sell it the next day. That's short-term trading. We want you as a mutual fund company to guard against that in your prospectus and to kick out that investor that will trade your mutual fund on a daily or weekly or even in some prospectus not more than 2 times a year or 3 times a year, because that disadvantages all the other investors. And the 1940 Act is there to protect the investors, the shareholders of the mutual fund. And the boards are there, independent boards are there to make sure you do that. So then they go through this process and they approve an ETF. Well, what's an ETF? You can trade it every minute. Well, wait a minute. It's a 40 Act fund. So you have one rules over here for a 40 Act fund, and you have a different rule for the ETF. And what allows you to trade an ETF every day, every hour? Well, what they do is they say, aha, here's what we're going to do. We're going to allow you to trade an ETF every day, and here's what you do. You give the portfolio to the market maker. Oh, you're playing cards, you give them your cards, right? And then they bet against you all day long. And they take that spread. That's an ETF. So who's profiting? The market makers, the hedge funds, the guys shorting. They're looking at there. They get to see you're buying Apple, they're shorting Apple. You're buying this, they're shorting it. So it is. I think it's a huge trend that I think will kind of correct itself, because it really, I think we're in a period that simply being in indexes is not going to work because of what I said earlier. We may be in a sideways volatile market, so if you're in an index, you're just going back and forth. So then the strategy becomes, oh, I can market time the indexing. I can get in, I can get out, I can get in, I can get it out. Short-term trading doesn't seem to work very much, but somehow this is going to work. So I think the trend towards indexing flies in the face of active management, and I think what it's really going to do for people like ourselves that are active managers can make our job easier to beat the market. If more money is in the index and less money is in it, we're going to be able to call out the stocks that are really doing well in there and end up beating the market. Market's up, I don't know, 18 or 15, whatever it is, we're up 40. Our global equity is up over 50% this year. Our convertibles are up 35%. It'll be easier for us, and I think we're in a period where active management works, which is counter to the trend because more and more people are going into indexing. Yes?
Yes. Earlier in the lecture, you talked about thinking of philosophy and thinking about the conception of justice. I would like to know personally, with your company, how do you balance the managing of your assets while still providing opportunities to people who are in need or people who are looking for opportunities but otherwise might not have?
How do we, I don't know exactly what that has with philosophy, but how do we provide opportunities for our staff that works in the company? Is that what you mean?
Well, not necessarily staff, but I'm more meaning of like communities who are in need. How do you reach back to the community, or how do you? People are looking for opportunities these days, and there's lots of people who are out of jobs who are just looking for a job. And so what I'm saying is, how do you balance managing this very prosperous company, but also being able to provide opportunities to people who need opportunities?
Yeah. Oh, that's, I understand. Well, there's two things that we do to help the community. The question is, how do we help the community, being a profitable company in two ways. First of all, if we weren't here in the western suburbs, there'd be X amount of jobs not here. So the more successful we are, the more jobs we can create. And in doing so, we actually have an apprentice system that's worked extremely well for us. Our investment management team, for the most part, has all grown up through our system. So we take kids out of school, We help them get their CFAs. We teach them our system, and that's worked extremely well. So we're creating jobs, and we're creating alignment. We're looking for people that are aligned. What does that mean? That they have a passion for what they're doing. They have a passion for what they're doing, and we want to give them that opportunity. It's not a gift, it's an opportunity. Gifts are something else. For how do we give back to the community? We do a lot of charity events. I'm a trustee of where I went to school at Illinois Institute of Technology. I'm a director and on the board of the Hellenic Museum, which I have a great affinity for the struggles of my parents coming here. So I want to make sure that isn't forgotten. So there are other things to do, but I'll tell you the best thing we can do is create jobs that are aligned with opportunity. Yes, sir.
A notion of greed has been put out there as the reason for the financial crisis. What would be your take on the, I guess, spread of blame for greed, misalignment, or an ignorance of systemic risk?
Yeah, and that's a great question. What is there's been a lot of talk about what went wrong was the sense of greed out there being a bad force, right? Boy, I tell you, if you can go in the archives and get the discussion on greed from Milton Friedman, he said it so well. But there, I think the term greed, just has such a negative tone to it. But is somebody working in their own self-interest, is that greedy? Is that greedy? Just because you're working in your own you're here going to college. Why are you going to college? Well, I'm trying to get better. Oh, is that greedy? So I think they take greed and really unethical behavior and they put it in the same amount. But greed by itself is self-interest. Hey, the more we have all of us working in our own self-interest, the more we raise the standard of living of everybody. So I would take issue with it was all greed. Was some greed? Were the greed that was unethical, peeking underneath the tent, the galleon, inside trading, is that greedy and unethical? But greed is not always unethical. And unethical behavior is what got a lot of them in trouble. So, I come down on, a society that everyone's working their own self-interest will benefit everybody in the society. And so, I hope I didn't offend anybody, but that's how I feel. Well, thank you very much. I appreciate it.